Hello, everyone, and welcome to episode 2 of the Annuity Lead. What I thought we would do today is a product overview of a 5-year fixed indexed annuity that I've been having a lot of conversations about. We've been getting a lot of questions about it. It's just getting quite a bit of attention. We're seeing cases come through fairly consistently, and I thought we would introduce just kind of a high-level overview out to all of you. Now, it's important that before we get into this, that anyone watching this understands that the material covered today is meant to be for educational purposes only for life insurance licensed individuals. And is not meant to be taken as a recommendation or investment advice. With that being said, we'll go ahead and get into things. What we're talking about today is the Athene Accumulator 5. Now, Athene released the Accumulator series of fixed indexed annuities in the beginning of January 2017. It's available in a 5, 7, and 10-year surrender period. We're just going to look at the 5-year today. If you have followed index annuities at all, cap rates on index annuities have not looked that great over the past few years, but now interest rates are rising and they're starting to get to levels where we can actually start looking at index annuities and getting some great accumulation potential out of them, especially when compared to other safe options that are out there. So what we're looking at right now is the rate sheet for the Accumulator 5. Please understand that I'm recording this in April of 2017. The rate sheet that's in effect currently is January 27, 2017. And rates are subject to change, as well as product strategies could change. Things about the product can change over time. So depending on when you're watching this video, just make sure that you're looking at whatever the current material is, and you can use this as a high-level overview resource for the product overview. All right, so let's go ahead and get into it. If we look at the rate sheet, on top, go ahead and find your state so you can be clear on any kind of state provisions there. I'm in California. We got a little note here that just tells us that in California, on this particular indexed annuity, there is no confinement or terminal illness waiver. However, in most all of the other states, you actually do have that. So as we scroll down, we're going to get into the interest crediting strategies that we can see here. Now, anytime anybody thinks about an indexed annuity, the first thing that everyone thinks of, it's kind of the most traditional approach to indexed annuities, is they think of the 1-year point-to-point index strategy on the S&P 500 index with a cap. And what we can see is that we do have premium banding here. There's a low band and a high band. For the course of this overview, I'm just going to talk about the rates based on the high band, assuming $100,000 or more. Cap rate right now, 5.75% cap. That is actually an incredibly strong cap rate for a 5-year indexed annuity in today's environment. So, kind of exciting just right there, right off the bat. We do have a bailout cap rate available as well. What a bailout rate is, if you're not familiar with it, well, each year on our contract anniversary date, we are going to get renewal rates on all of our caps and spreads. Right, so currently, while in the first year, we're going to have a 5.75% cap on our contract anniversary, that can renew. It could go up, it could go down, it could stay the same. However, what Athene is telling us is that, look, if we ever renew that cap rate and that rate drops below your bailout rate that's set at 3% for the 5-year surrender period on your policy, well, if next year, in year 2, policy renews and your new cap rate's 2.99%, well, you now can get out of the policy. You can bail out of that policy, keep all the interest that you've earned, and you can walk away surrender charge free. So, nice provision inside of the policy. Oftentimes, I've heard people refer to renewal rates as trust me rates. So we're just supposed to trust that the rates are going to renew at a good, fair rate to the client. Well, in this case, they put this bailout cap provision in there to help you understand that, look, if the rate's ever renewed and they renewed lower than 3%, great, client can get out. So, great provision. On top of this, the fixed accounts actually are very, very strong. 2.2% fixed on the low band, 2.45% fixed on the high band. Those are really good fixed accounts inside of a fixed indexed annuity. However, that's not necessarily what's most popular or getting the most attention about this policy. If we look up at the top, we can see that using the BNP Paribas Multi-Asset Diversified 5 Index, So instead of the S&P 500 index, we're looking at this BNP index, and we're going to call it the MAD 5 for the duration of this overview. When looking at the MAD 5, well, we now have two different crediting strategies available. There is a 2-year no-cap point-to-point index strategy with a participation rate, and a 1-year no-cap point-to-point index strategy with a participation rate. And on the high band, if you're going with the 2-year strategy, you have a 135% participation rate. That's with no cap and no spreads, no margins. You just get 135% participation on the return of the index over that 2-year period. On the 1-year strategy, we get 95% participation. So had the index gone up 10% over the course of that one policy year, you would receive 95% of 10%, or 9.5% interest credited to the contract. Now, those are really good rates. Within the rest of the policy, we do have some other options. There's participation strategies on this Morningstar Dividend Yield Focused Target Volatility 5 Index. We also have 80% participation rate on the high band using the S&P 500 Daily Risk Control 5% Index TR, or Total Return Index. The point is that there's different interest crediting strategies that are available in here, but the BNP has had, when you run the historical illustrations, you find the BNP has the better returns. Client can allocate across any of these interest crediting strategies however they like. So if they wanted to go, let's say 25% of their allocation into 4 different interest crediting strategies, or they wanted to go 50-50 or 70-30 or something along those lines, that's available to them. Then on policy anniversary date, they have the ability to reallocate into new strategies again. So question comes into play, well, what's better? Is this BNP MAD 5 index, is it really going to provide better returns than the S&P 500 with a great cap rate at 5.75% on that high band? First and foremost, what we need to understand about the BNP MAD 5 is this is what's called a volatility control index, which means that it's not all equities. So inside of the S&P 500, that is all equity. It's it's 500 U.S. stock-based companies. Whereas in the BNP, they're actually using asset allocation, where they're allocating across multiple different asset classes. So what asset classes are they using? If we look at this BNP Paribas MAD 5 fact sheet, I'm going to scroll to the bottom of the fact sheet here. And just as a kind of nice little overview, it gives us this breakdown of the different asset classes that they are allocating across. So we have 2 commodity asset classes, 2 U.S. asset classes, 2 European asset classes, and 2 Japanese. Now, if you're familiar with volatility control indices, you'll want to know that the volatility target on this is 5%. So they have a 5% volatility target. The question is, which equity components, conservative components, commodities are being used? And on this fact sheet that we're looking at here, which we can provide to you, it gives us the equity side, which U.S., Eurozone, and Japan equities are being used. They give us the ticker symbol, so we can get in there. We can look at each one of those indexes. Same thing on the bond future indices that they're using for the conservative allocation and the commodity indices. Additionally, on this page, it tells us where we can go to the website for this MAD 5 index. So what I like to do when researching on that website, if we go to madindex.bnpparibas.com, when you log in, now I'm already logged in, I've gotten there previously. What will happen is when you get to the home page, you'll have to go to the bottom, and on the bottom left, there will be 2 checkboxes that you have to click to get into the page that I'm looking at right now. But after you click those 2 checkboxes, on the top right, it's got this link for index performance. Once we arrive at this index performance page, if we scroll down, they give us a very nice look or view at how the BNP has done in comparison to the S&P 500 index from the 2003 all the way through 2016. So when you get to this page, you can see that in 2016, when the S&P 500 index did 9.54%, well, the BNP MAD 5 index did 5.94%. So a more conservative return because of that volatility control component that they have there. right? In a year like 2013, S&P does 29%, 29.6%, and the BNP did 10.05. But if we look at a year that is negative on the S&P, where 2008, when the S&P was negative 38.49%, well, the BNP returned at 3.44%. Anyway, this is a great page for us to go to and just be able to make some comparisons and get a good understanding of what kind of expectations we should have as far as the returns on that indice itself and how it compares to what the S&P 500 index would be doing. This is just to give us a broad overview. You can see that the returns are kind of all over, but you do get generally a more conservative return out of the BNP than you would in comparison to the S&P 500 index. That being said, let's go ahead and look at a couple of last details here before we finish this up. This is a sample illustration. And in this sample illustration, if I were to go to page 3, it gives us a little summary. And on page 3, it shows that in this first sample, we're looking at the 1-year no cap strategy on that BNP MAD 5 index with the 95% participation rate. And what I like to do on this illustration is I go directly to it's page 10 of the illustration. And what page 10 shows us is it gives us the performance of the most recent 10 years, the highest performing 10 years out of the most recent 20 years, and the lowest performing 10-year period out of the last 20 years. And what you could find is that if you look, yes, you can get the annual returns in each of those different periods, but if you look directly below the box, it gives you the geometric mean assumed interest rate over that period of time. And what a geometric mean assumed interest rate is that is the compounded rate of return that you would have had to have received each year for 10 years in a row in this case in order to arrive at the same value. So $100,000 goes in up front, it grows at 5% compounded each year, and then that would grow to the $163,017 that we're seeing here. That being said, in the lowest performing 10 years out of the most recent 20 years, they're showing us it was the equivalent of a compounded 5%. The highest performing 10 years was 6%, and the most recent 10 years came back at 5.31% as our geometric assumed interest rate. So we have a 5-year principal protected product where we can see that we've gotten returns between 5% on the low performing side to 6% on the high performing side in a safe option. Last portion to see here, and some people will ask, is well, what were the actual years on the highest and the lowest? That's just directly on the second page of the illustration. It gives us the actual dates here. Okay, what's interesting is that the years are the same on the highest and the lowest, but the month that you got into the plan is what dictated whether it was the lowest performing or the highest performing, which is very true when looking at indexed annuities that are based on contract anniversary date, not calendar years. The last thing that we'll look at here, and then we'll tie it up, is the sample illustration for that 2-year strategy, which we can see here. 2-year no cap on the BNP, 135% participation rate. When we scroll down to page 10, look at those same 3 boxes. Lowest performing 10 years ended at 6.99%, highest was 8.08, and the most recent was at 7.44. This should not be taken as an assumption for what expected returns will be here moving forward in the future, but it gives us a great look at 3 different 10-year time periods and the type of performance that they received out of this 5-year fixed indexed annuity. Well, I hope you found this information to be helpful. We'll be looking to release more product overviews. There's a lot more information on these products. I'm just kind of giving you the key feature highlights that I like to look at when kind of doing the review. For more information, you're welcome to give us a call here at 877-455-0119. Ask for our annuity department. We can get you fact sheets, brochures, illustrations, rate sheets, so answer any questions that you may have that weren't answered during the course of this video. Please note that prior to the implementation of any of the ideas shared on today's show, always consult your tax advisor, legal counsel, or broker-dealer compliance officer. On that note, I'm Josh Garland. I'm the Director of Annuity Marketing here at FPG, and you've been watching the Annuity Lead.